Hey guys, this is Tyler, and today I'm going to be presenting on the portion of FASB 160 that discusses changes in a parent's ownership in a subsidiary, and I'll be focusing on what happens when a parent loses control of a subsidiary. The portion of FASB 160 that discusses this is paragraphs 35 through 37, which basically states that a parent must deconsolidate on the date it loses control of a subsidiary. This could happen in a few ways. Basically, if a parent sells some of its stock, or if the subsidiary issues more stock, that makes the parent's control no longer a controlling percentage. When control is maintained after a change in ownership, there is no gain or loss recognized on the income statement. All of that just goes into additional paid-in capital. But when control is lost, the entire interest is adjusted to fair value, and the gain or loss is recorded on all shares owned prior to sale. Today we're going to be focusing on the cost method and how to account for deconsolidation using this method. The parent accounts for deconsolidation using a gain or loss in net income attributable to the parent. This gain or loss is calculated as the difference between two items: one, the carrying value of S company's equity, and two, the sum of three different objects. First of all, the fair value of consideration received, so the fair value of the money you got for selling your shares, for example. Two, the fair value of retained non-controlling interest. So if you originally owned 70% and you sold enough of your shares to get you down to 30%, then this would be the fair value of the 30% that you retain. And three, the carrying value of the former non-controlling interest before the change in ownership. Now to dive into our CPA example problem. First of all, this problem sets up a few variables. First of all, P Company owns 9,000 shares, which is 90% of S Company. That will make 100% 10,000 shares. These shares were acquired for $225,000, $25 a share, on January 1st, 2012. And S Company reported $60,000 in net income with no dividends during 2012. Now, in 2013, P Company sold two-thirds of its investment, which is 6,000 shares, in S Company for $180,000 or $30 per share on January 1st, 2013. After the sale, P Company lost control and now maintains a 30% interest, which is calculated by using the original shares, 9,000, minus the shares sold, 6,000, over the total shares, which is 10,000. So since we are down to 30% controlling interest, or non-controlling interest, that means that we have lost control, and we therefore need to find the gain or loss, which is the difference mentioned in the previous slide between the carrying value of S Company's equity and the sum of the three items we discussed. First of all, we're going to find the carrying value of S Company's equity. So to do that, we're going to add together the investment in S and the non-controlling interest. First of all, to find the investment in S, we add the initial cost, which is 9,000 shares purchased times $25 a share, what they originally purchased the company for, which is $225,000. Then we take the parent share of S Company's net income. So S Company had $60,000 net income for 2012, and during 2012, P Company owned 90%. So that's going to be 54,000 added together is going to be 279,000. Then to find the carrying value of the non-controlling interest, we take, just like with the investment, we have the initial value, which is the remaining 1,000 shares times $25 a share, 25,000, and we take the 10% of retained earnings for S's net income. So that's 60,000 times 10% is 6,000, which equals $31,000. Then those added together is $310,000, which is going to be the total carrying value of S Company's equity. Next, we're going to find the sum of the three items we discussed previously. So first of all, we have the fair value of consideration received. So we sold 6,000 shares at $30 a share. So for that, we got $180,000. Then we have the fair value of the retained non-controlling interest. So after selling our shares, we still retain 3,000 shares, or 30% of the company. So that times $30 a share is going to be 90,000. And next we have the prior carrying value of non-controlling interest. So on the previous slide in the middle, we found the value of the non-controlling interest during 2012, and that's what this number is. Then on the top right, by the orange arrow, you see we have the carrying value of S's equity. And then below that, we have the three items added up for 301,000. So the difference between those is going to be 9,000, which will actually be recorded as a loss. And now we're going to move on to our journal entries. So first we're going to debit cash for the amount received for selling our shares. So we sold 6,000 shares at $30 a share, so we got 180,000. Then we have the realized loss on sale of 6,000. We're going to debit as well. We'll get into that in the next journal entry. And then we're also going to credit the investment in S company for the amount that we sold. So the investment in S company is valued at $279,000, and we sold 2/3 of our shares. So we're going to credit investment in S company by the 2/3 that we sold, which is $186,000. Then we have the unrealized loss, which is 3,000, and the investment in S company again, which is also 3,000. To find this amount, this is going to be the difference between the book value and the fair value of the amount that we still own. So the book value is going to be the remaining 1/3 that we still own times $279,000. So that'll be $93,000. Then we have the fair value, which is going to be the 3,000 shares we still own times what we sold it for, which is $30 a share, equals $90,000. Difference between 93,000 and 90,000 is 3,000, so we leave $3,000 unrealized. So before, when P Company owned 90% of S Company, they used the cost method, but now that they are down to 30%, they are required to use the equity method. So we have this ending reciprocity entry, where we basically just convert from the cost method to the equity method. So we debit investment in S Company for $60,000 times 90%, which is what they own in 2012, and then we credit the January 1st retained earnings of P Company by that same amount to convert to the equity method. For my video, I used a lecture by Professor Farhat, and this concludes my presentation. Thank you for watching.